Hey, thanks for listening to the Futurists podcast. Just a quick thing before we proceed on with the show. The only tiny favor that I'll ask from you is to click on the follow button on whichever platform you're listening from. It really helps our podcast to reach more people like you. All right, I hope you enjoy the show.
Now, just to keep you on track, on April the 2nd, which is last Wednesday, Donald Trump unveiled sweeping tariffs across multiple countries. He held up an infamous board during his speech, which I will also pin up in this space later. You may have a look at it, and you'll see that Malaysia has been hit with 24% reciprocal tariffs from the White House. So Trump argues that tariffs will bring back industrialization to America. He believes that other nations have become more rich and powerful at America's expense, and that foreign countries, whether friend or foe, have quote unquote looted, pillaged, raped, and plundered the beautiful country. So the steep tariffs will encourage US consumers to buy more local made goods and major companies to build their factories in the country. At least that's what Trump hopes. To make America wealthy again was one of the opening lines of his speech. But so far, America is not becoming more wealthy. In fact, the US stock market has tanked over 8% since Trump's speech, while global markets, including the FBM KLCI, have seen a similar decline. It's just chaos. So, yeah, Han, in layman terms, do you mind explaining what these tariffs are and how they will impact everyday consumers? Yeah, we are seeing the market crash and all, but at the end of the day, how will it affect us?
Mm. I guess, yeah. Happy tariff week, everybody. But I guess we just go back one step to figure out what is a tariff actually. It's very simple. A tariff is a tax on imported goods. So in Malaysia, we're quite familiar lah. The best example I can give is, you know how every time we want to buy cars, how come cars so expensive here if you're a foreign car versus a local car, right? Uh, uh, so just to give you a sense, Malaysia has more than a tariff on foreign cars lah. So whenever someone tries to import a car in, and it's a bit more complicated than this blanket one tariff. It's like, that's like what's CKD and CBU and all that stuff. But the long story short is, you want to import something from overseas versus buy local, the imported stuff will be taxed more, will be taxed upon arrival lah. So for the person that has to buy the thing, it's going to cost more. So that's what tariffs are. Now, what the US has done, I think it was last Wednesday. Yes, last Wednesday, is put very high, unheard of high tariffs on pretty much all goods coming into America from every single country, 190 countries in the world. Tariffs ranging from 10% to as high as, I want to say, 46, 50%. And actually, in China's case, it's over 75% at the moment lah. So huge tariffs. Can you imagine every single thing going to America, costing American business or American consumer anywhere between 10% to I think from China it's 70 something already, 74% higher. So long story short, it's going to affect firstly people trying to sell into America, and it's going to affect Americans who buy things from overseas. So just imagine a very big country buy a lot of things, but now it's going to be harder to do that. So and then obviously you're going to ask, but then how does it affect me here? Because I don't sell anything to America. Maybe you don't, but let's just say many Malaysian companies do, and that's why you're seeing a damage in the stock market locally and actually everywhere around the world, right?
Yeah, huge damage lah.
Huge damage, right?
Very.
And that's how it's affecting us today, right now, lah. But the second order effects are going to be even bigger. We can talk about that later.
Yeah, sure. I'll pass the mic over to Mrs. Sani. What are tariffs? How will they impact everyday consumers?
Well, Econs 101 would tell you that tariffs are basically a tax on a good, basically. So it's paid by the importing country, the importers, not by the exporters. So you put it into this case, China's the exporter, American companies like Walmart importing Chinese goods, they are the importer. So Walmart will be levied with a tariff to bring in those Chinese goods. So the biggest question now is whether Walmart can transfer that increase in the cost of bringing in those goods or over to the consumer. So that would definitely make the end product higher priced because if Walmart wants to maintain its margin, it has to pass it over. Of course, not different industries will be different. There are some industries which are what we call in econs very elastic, the demand, and so it's very difficult to pass over prices. And when you can't pass over this increase in the tariff rate, you then have to absorb it, i.e., the businesses will have to take the loss, not the loss, sorry, but the businesses will have to take the higher costs, resulting in thinner margins, a squeeze on their margins. And I think that's really what, in my view, something which is affecting the markets because, again, there are many other factors, but one of them is also that profitability of businesses will probably be affected.
Yeah, what about those businesses who want to maintain their profit margins? At the end of the day, they can just pass the cost of these tariffs to consumers, right? Which, will lead to higher prices overall. What do you think?
Yes, correct. So it's a question of what product or service you're offering. If the product and service offered in econs term is inelastic, i.e., an increase in price will not result in equal or will result in a lesser increase in a decrease in your quantity demanded, then you'll find that basically no problem. You actually not only maintain your margin, you probably even do better. But it's those products which have very elastic demand where if you increase price, you'll find that your demand drops in terms of percentage terms much more than the increase in price, and net you tend to lose out. So it could differ from case to case basis. So it's a question, but both sides, it's either the consumer takes the hit or the companies margins take the hit. So either way, it's probably a lose-lose from that perspective.
Yeah, Han, over to you lah. Since the tariffs are on the US side right now, the US are charging other countries. People can argue that the prices are just probably high in the US. How will this impact the other countries and the world as well?
Um, it impacts major people exporters to the US. So let's say you are a country which exports a lot to the US, a country like China for sure, yes, but also importantly like Vietnam. Vietnam is a very big US export importing country, meaning out compared to the size of its economy, Vietnam exports a lot to the US. And if you're slapped with like a 40-something% tariff, that's gonna hurt, right? Because you were selling things all the way from kind of shoes to clothes to little knickknacks. Those are going to cost more. So imagine the Nike shoe that costs like $100 US. Now going to cost $150. Like that's naturally going to impact Nike, yes, but also the person considering a Nike shoe, right? Then you're like, hey, it's supposed to cost $100 US. Now it's costing 150. That kind of quantum is going to for sure change your purchasing decision, right? Another example is like let's say like 80% of iPhones are made in China. If there's a tariff on iPhones going into the US, like your one, in Malaysia it's 4,000 ringgit, right? $1,000 iPhone is now, $1,600. Right? How does as in that's gonna make a big. We can immediately, just think about how we would think about making that purchase decision, right? It's a big impact. So what's going to happen is people are going to buy less in the US, right? So rather people in the US are going to buy less of those stuff, right? Which going to impact yes, the economy of the States, because it's a highly consumption-driven economy, but it's also going to impact the exporter, right? If I cannot sell my stuff to US because nobody wants to buy it anymore, then that's going to affect my sales, affect my profitability, affect my business. Then I'm going to have to do things like scale down my production, fire some people if I'm in a factory in Vietnam or a semiconductor factory here in Malaysia or Foxconn in China. I'm going to have to readjust, right? Because I cannot sell as many iPhones or clothes or Nike shoes or whatever to the US anymore.
Mr. Sani, I saw you unmuting yourself. You got anything to add?
Yeah, I think for those of you who know the equation for GDP, which is C plus I plus G, X minus M, consumption plus investment, government spending, and export minus imports. Han mentioned about consumption. So if this hits consumption, higher prices results in consumers holding back on their consumption, then of course straight away the C component gets hit, which means GDP goes down based on a decline in consumption. Investments from businesses, we are already hearing many businesses are holding back their investments because no one wants to make, although Trump says this will bring businesses back into the US, no one, unless they've already planned it, no one's going to build a multi-million dollar factory or warehouse in the US or start a business in the US when things are so uncertain. They could do so, and maybe the next administration that comes in changes it, or they could do so, and maybe Trump halfway through says that, since we're going to the negotiation table, I will reduce the tariffs or get rid of this tariff with so-called country XYZ. And then that decision has been made to invest in the US based on a pretext of tariffs being there, and now tariffs are not there. So who wants to make decisions in this kind of environment? No one. And so the I component of GDP goes down. And then you go and look at the G component, the government component. Government spending is basically made up of either increase in direct government spending or a reduction in taxes. Yes, there are talks of Trump administration reducing taxes, but that's being kind of neutralized by his massive cut in government spending, i.e., the workers and so on. So the G component is also neutralized and not really, on fifth gear. And then you go to the X minus M itself. M is the imports component. It's a minus sign. Okay, so basically, the bigger it is, it takes away from growth. Okay. So in this particular case, well, you could argue that basically there'll be less imports and so on. So maybe that number is not going to be very big. But I think it's the X component which everybody misses out on. The X component is the US exporting out to the rest of the world. Okay. So in this particular case, you have basically every country in the world retaliating against US exports. I'm not going to bring in any more US exports, or I'm going to tariff US exports so high, i.e., when they come to my side, it's imports, but I'm going to tariff them so high that there's no demand for it. And so the X component for the US is going to drop tremendously because it's fighting against every single country in the world. Every single country is going to retaliate. Okay. And so you have a situation whereby every component of growth in the US in this particular equation being pressured, or there's a headwind onto it. So we're not surprised to hear now people saying by the second quarter of this year, the US is going to go into a recession. Whether it's going to pull the global growth into a recession, left to be seen, potentially could be, but quite certain that the US is going to slow because it has just shot itself in the foot.
Yeah, I mean, Han, previously you posted in our WhatsApp group a very funny headline from the Wall Street Journal, quote, the dumbest trade war in history. Yeah, do you mind elaborating more on that? And based on what Sani said about uncertainties just now, can you give the audience just a bit of idea of what's really going on in the markets right now, how bad the crash is?
Sure. I guess there's two points there to mention, right? The first is, yeah, as in that was quite a funny headline which I spotted, right? That is really a dumb trade war, i.e., totally self-inflicted. No one, as in it stems from a total misunderstanding of how the global trading system works. In that you assume that if you have a big trade deficit is a bad thing. It can be good and bad, but for me, a trade deficit in itself is not necessarily a bad thing, right? For example, a trade deficit in Sri Lanka is a bad thing, right? They're not self-sufficient. They have to import all their oil and their fertilizers to keep their economy going. It's very expensive, leaves them at high risk of economic shocks. A trade deficit in the US is actually a very positive sign for them. It means that they are a very powerful, strong economy which can afford to buy things from all over the world, right? And a huge consumer base, and yeah, they account for almost 30% of almost 30%, I think, of global consumer spending, right? Which is huge. It's a very, very big consumer. So for them, it's a good thing. And the reason why I say the Wall Street Journal said is the dumbest trade war is because the US has misunderstood, or not US lah, the current administration has totally misunderstood that having a large trade deficit does not mean like you are like losing out. In fact, you are it's a symptom of you being very strong actually. And launching a trade war to reverse it, you can reverse a trade deficit by making yourself weaker, then therefore cannot buy so many things from the world, and therefore you have no trade deficit, right? But then your economy is much 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 weaker. Are you sure you want that, right? So for me, like launching a trade war like this is very dumb. And the part of them why they say it's dumb is he launched it on his closest neighbors first, guys that were basically subservient to the US economy. You go and smack them first. Super dumb trade war. So that's kind of on the first part. Why is this the stupidest thing ever? It's a bit like, like people are serving you and you're just classic example, right? You go to Giant, or you go buy some groceries, right? And then wow, so cheap, I buy more. Then you get very angry because, hey, why am I losing money to Giant? I'm finding I'm spending more and more at Giant. Then people explaining to you, hey, you spend more at Giant because they're pushing down the price for you, making things very cheap for you to buy. You are a very, very rich consumer now. You can buy a lot of things. TV costs 65-inch TV costs 500 ringgit now. iPhone for you now costs 2,000 ringgit. Very cheap, very cheap. And you buy more and you're getting angry because you're giving Giant too much of your money. Therefore, you launch a trade war against Giant. That's literally what the US is doing, right? The dumbest trade war, the super dumb trade war, right? Um, and what's happening is that markets are reacting to two things. One, the stupidity of the situation, because they realize that actually the tariffs being put on have no economic basis to them. It's just a random formula which they've used, which is trade deficit divided by imports, divide by two. Really arbitrary voodoo economics, they call it. Arbitrary tariffs that have no specific economic reason to doing so. It's not like you go like, I think, Malaysia, they charge 30% import duty on my Ford Fiesta car. Okay, I'm gonna slap them back on all Proton cars coming to United States, same tariff, 30%. Then you can go, okay, that's kind of reciprocal, totally understand, very specific. You want us to stop to remove our import duty on Ford Fiesta coming in. Okay lah. There's some rationale there, right? This one has zero rationale. And so the kind of capital markets, the stock markets, the bond markets are reacting to one hand stupidity, which is, this policy makes no sense. Does this mean the whole administration has no smart people and really dumb people? I thought they're smart people. Howard Lutnick, Scott Bessent, supposedly smart guys, hedge fund guys, business guys. Why are they doing stupid things like this? Then it comes out later that they had almost nothing to do with these tariffs. It was literally Trump saying, okay, we're going to do this, and I'm going to look like a great deal maker by slashing in half, even though the number itself doesn't make sense. So that's one, stupidity. And the second is uncertainty. I think Sani mentioned just now, right, which is markets react to the fact that they know businesses are very uncertain now. There's no way I'm going to invest in a new factory anywhere now, which is bad for the economy, right? Bad for economy, bad for earnings, bad for stock prices. So yeah, two big things that's affecting markets right now.
Yeah, I'm just turning over to you lah. Thoughts on the dumbest trade war in history?
No, I think the markets were shocked by the way they calculated the tariffs. Han correctly pointed out, of course, we all know now that it is the trade balance divided by the import divided by two. This thing, the objective is to penalize countries that supposedly have trade surpluses with the US, i.e., trade deficit on the US side, and is headlined as tariff related. When you have a trade deficit, i.e., the US has a trade deficit with whatever country, let's say China, that trade deficit divided by imports doesn't necessarily give you the percentage tariff level that's being charged by by China. You know, it just tells you basically this is the percentage import over trade deficit over import. Within that trade deficit, some items may be tariff higher, some items may be tariff lower, some items may not have tariff, some items are tariff free, and so on. So what this formula has done, I believe, is that it has set a tariff rate significantly higher than what the actual reality is. And so when the market looks at the tariff rates, it goes, oh my God, we're now, the US is now imposing, we're not talking about single digit tariffs which exist in reality. They're imposing tariffs which are 3, 4 times more than what countries are facing now. And over the weekend, China reciprocated by slapping on all US goods, I believe 34%, which is in retaliation. And so China has done the same. And so this tit for tat is based on a number which overstates the actual tariff that's actually being imposed currently. So it's nothing to do with tariffs anymore, this problem. And so if you suddenly impose 34%, no one knows. I can bet you now. I can bet you no one knows what's going to happen to the demand for goods because no one has ever experienced this kind of sudden increase in tariff amounts. We've lived in the world for the past 30, 40, 50 years since GATT, General Agreement on Tariff and Trade, which was replaced by the WTO, I think in 1995, in a world which is rule-based, where tariffs, the main goal was to reduce the barriers on tariffs. Can you imagine? Past 30, 40 years has been to reduce tariffs. One of the biggest, if not the biggest beneficiary has been the US. And now you are maximizing tariffs. So you've gone from one end of the spectrum to another end, from almost zero tariffs to now 34%. I mean, I don't think there's any model that people have that can really tell you how much impact this is going to have on demand, on the world economy. I think, and the market, when the market is uncertain, what does the market do? The market sells first and asks questions later. And that is why you just look at any chart and what you see straight bars down, which you've never seen before. So this is the repercussion of this kind of stupidity in terms of not well thought through at all kind of situation.
Malaysia has been hit with 24% reciprocal tariffs from the US, but fortunately our semiconductors and E&E industries, they are exempted. But just now, as Han rightfully mentioned, which I will pass the question to you, Han, many economists as well as analysts are questioning the validity of Trump's tariffs, voodoo economics. So does Malaysia actually charge 47% tariffs to the US as indicated by the White House?
Short answer is no, we don't. We have a surplus of 47% over the amount of imports that we have. So what I mean by that is we import, I think about 200 billion ringgit, or rather, we export 200 billion ringgit to the US. So they import 200 billion ringgit from us. And our surplus with them is about 90 billion ringgit. It's quite big, right? It's like two-thirds of Malaysia's, or about maybe 50 to 60% of Malaysia's overall trade surplus overall. So actually our trade surplus US is huge, right? So that's about 47% over the amount of imports, right? So like, what's that, 90 billion over 90 something billion over 200 billion? Yeah, about 47. So they say tariffs, but if you look at the fine print of that stupid cardboard cutout, right, it doesn't just say tariffs. It means there's a whole sentence under the word tariffs one. It's like tariffs and like manipulation of currency and like all kinds of trade barriers, non-tariff barriers. Just to give them an outlet to say that, hey, we know this is not the tariff Malaysia charges, but you do all the little extra stuff, currency manipulation that they claim. Other trade barriers, random things that they do. The Europeans, for example, do a lot of regulatory barriers on American goods because they say American goods, especially American food, has a lot of additives that we don't want to have, we don't want to buy. So stuff like that, they just say, okay, because of all that, our deficit with you is X, therefore that's why it's 47%. Right? So that's we don't actually charge a tariff to that big to pretty much everyone, right? Anyone, right? Our average tariff is in the single digits, right, to the world, right? And to the US, I think it's even smaller because uh, it's not that we need to tariff the US too much because we don't really buy much from the US anyway. So I think our effective tariff across all goods with the US is something like 1 to 2%. It's really, really small. Right, 47% is literally our trade balance, our surplus of imports. Right, it's quite crazy. And but it's bad lah. It's in we are comparatively not as bad because the rest of ASEAN is hit even worse. I think Vietnam's the highest. 40 something I think was the tariff hit on Vietnam because they claim 90% tariff from Vietnam to US, and then therefore I think 46% on Vietnam. Indonesia is higher. The only one that's lower than us is Singapore, 10%. And what's funny is that Singapore actually has a trade deficit with the States, i.e., the US is in surplus with Singapore, but Singapore still kena. So no one was spared. That's why they say it's just the stupidest trade war ever, lah. No basis one. But yeah, just to let everyone know, we do not charge 47% tariff on US goods. Our trade weighted it's a technical term lah, but trade weighted tariff rate is about 1 point something to 2% lah. It's very, very small.
Mr. Sani, go ahead.
Yeah, this is exactly, Han put it very nicely with the numbers. So can you imagine from 1% now to what, 47%? And so what kind of impact that would have on the trade flows between those two countries, US and Malaysia? How do you calculate even this thing from 1 to 47? So I think that's the thing which markets are not very happy about, and they sell first and ask questions later. The other thing is basically the US is acting unilaterally. It does whatever it wants to do. It's been with the low tariffs, no tariffs, supportive of GATT, supportive of world trade, when it felt that it was the best thing to do. And all of a sudden now it's just throwing that whole thing down the drain and say, I want to do this, and everybody has to adhere to how I do things. And it's not the first time that it's done so. It's come out from climate change agreements. It's backed out from FTAs. It's done things, and this is one of the biggest examples of the US just doing unilaterally what it wants. So much so now that I tell you, very few countries in the world, if they have an agreement with the US, that behind closed doors they probably say, this, I'm not sure whether the US will honor its side of the agreement. One of the latest news coming out, I think Germany is repatriating gold from the US because if the US is not going to play as an equal partner and adhere and conform to agreements, who's to say that the US may not suddenly just confiscate the gold that's sitting on US soil, even for an ally like Germany. And so again, this is another dynamic which I think is causing markets to kind of like another thing to discount. How do I discount this? Haven't discounted the tariff situation fully yet, the retaliation. Haven't discounted as all these people want to unwind their relationship with the US and start new bilateral relationship ex-US outside of the US. Haven't even discounted how bad the recession is going to be. And that's what you get when you haven't discounted all of this. It's a market which just um, sells off first and wait for answers later.
Han, you just now mentioned that Malaysia has a trade surplus against the US. The figures came out at about 90 billion ringgit last I heard. So, how important is the US to Malaysia as a trading partner? I'm assuming it's very important, but how does it compare to other nations, say like China?
Yeah, I'd say if this happened 20 years ago, we'd be very, very, very worried because US was was much bigger as a percentage of global trade than it is today. Today, between China, ASEAN, EU, Mercosur, the South American guys, they've really come up in trade also lah. So like, we are far more diversified as a trading globe world right now. To give everyone context, I would say, if you look at 2024 numbers, US was about 13% of our exports, 13. The rest of ASEAN is 30%, China also about 13, EU 8, Hong Kong 5, 6, Japan 5, 6. But so it's quite diversified. 13% is not super large. It's big. It's the second biggest of obviously behind ASEAN. ASEAN 30%, right? But 30%. If we will lose it entirely, it's gonna be painful. But not like devastating, right? Classic example, like in the past year, our trade went up 10%, right? So it just means that we go back a couple of years in terms of trading size with the US. And then on the import side, US is about 10% of our imports. So on an average basis, it's probably about 11-12% of our total trade. So 11% of total trade is painful but not devastating, to give everyone a sense. The bigger one that will affect Malaysia GDP is that if the trade balance with the US, which is very big, I misspoke earlier, it's probably about 75 to 80 billion ringgit, not 90, right? 75 to 80 billion ringgit. That's 3 to 4% of our GDP, which could be at risk, right? And if you think about it, our target GDP is 5% this year, right? Any 3 to 4% hit is big. Right? It won't hit us into recession alone, but reducing our trade balance significantly will obviously reduce GDP, because you remember Sani's formula just now, right? X minus M. Our X minus M with the US is big, right? It's 3 to 4% of our GDP. If that shrinks, then obviously our GDP shrinks, right? And that doesn't even count overall trade, not just this 11%, 12% going down to something smaller, right? Is everyone else trading less because of what the US has done, right? So there's a big risk. The bigger risk is not just the US doing stupid things, it's the fact that everybody else does stupid things. And overall trade in the whole world goes down, and then we can't really take these kind of two big hits. One big hit, the US going down, probably okay, painful, go through it lah. Take 1 year of much lower growth. But if the overall global economy, the global trading system trades less, that's when you will feel serious pain, like kind of 2008, 2009 pain. For Malaysia, 97, 98 kind of pain, right? And we got to be prepared for that lah.
If there is a probability for you to put probably 2080 or probably 4050 when it comes to a recession, what would it be?
Malaysia, not likely lah, not likely. And depends how you define recession. Personally, in Malaysia, anything below 3% growth, I consider recession really. Even though it's not considered a recession by most economists. But for a developing country like us, we absolutely need growth, right? A bad year, 2-3% is considered recessionary in my mind. Even though it's not negative, but for an emerging economy trying to get into high income status, we really need to be at like 4, 5, 6%, right? To really get out of this middle income or developing economy status. For a developed economy, they're happy with 2% growth, and if recession is negative lah. For us, our standards are higher because we have a lot more gap to grow to these developed countries. So we should not accept less than 3%, or rather anything less than 3%, I consider a recession. And it is possible we go below 3 lah. If really all this tit for tat happens, China goes to 34, EU goes to 20, reciprocal. Hopefully it's just reciprocal with the US and not with everybody else. Seems to be okay so far, but you never know, because the US may pick individual countries off against the EU and China, for example, and then we're being forced to choose, and then that's going to impact global trade for sure.
Yeah, and I think the response to this is we look at the markets, how it has just crashed in the past few days itself. Now, Mr. Sani, the Singapore PM recently released a chilling statement about the very real risk of the tiny nation being left out in the new world of Trump's tariffs. Have you watched the video and do you agree with his statement since you are currently based in Singapore?
Yeah, I've watched it, and I totally agree. I can understand where Singapore is coming from. First of all, it's a small open economy, very highly dependent on the world trading among themselves, among countries. It's the banking system here, the wealth management sector, the port, the shipping, and so on. So it's a vibrant economy dependent on global growth, chugging along. But I think more important because we've gone through global recessions. Rather, Singapore has gone through global recessions before. So, and we've come out from it, and it's cyclical in nature. So, not to say it's we want one, but we've survived many global recessions before. you know. But the thing that's different this time around is that there is a dismantling of institutions that have so far benefited smaller countries like Singapore. Just take, for example, WTO and or the tariffs. So if WTO's role or mandate was to try and ensure fair trading, low tariffs among all member states, regardless of their size, countries like Singapore benefit because in itself the country is too small to negotiate with any significant strength or bargaining power when negotiating with bigger countries. But under the umbrella of WTO, it's able to benefit from the overall attempt to bring down the barriers from across the world. Take that away, if Singapore is required to negotiate on itself, then it has issues. Then it will have to now try and partner maybe with ASEAN to see how even ASEAN countries which are large, like Malaysia and such, again, individually bargaining power is not very high. So ASEAN may now come together as a grouping to negotiate deals with other blocs or other countries as well. Because without, or rather, or who knows, maybe the WTO may just now come together again and say let's heck care the US, do everything minus the US, and we just continue among ourselves like the last time. It could, which is probably a good case. But things are a little bit uncertain because the biggest elephant in the room, the biggest guy in the room now is saying, do it on my terms. And I've just watched someone on YouTube say the US is literally now saying I've I'm attempting to hold you at gunpoint, or it's the US is attempting to hold countries at gunpoint and say you must come and negotiate with me one to one, and I will make this deal with you in order for me to release you from these high tariffs and so on and so forth. So the smaller countries like Vietnam and everybody have to go and kowtow to the US. The bigger countries who are not going to take any of this, like China, is going to say, I'm going to retaliate, and Canada is going to retaliate. And so you have a situation now where the US is no longer playing multilateral by the rules of to make everybody a win-win situation. It is basically saying we negotiate, and if I yield a higher bargaining power than you, then you can imagine how much the US will try and extract from these countries. So it's not a pleasant environment, basically.
With other countries responding with their own tariffs and countermeasures as well, where do you see the market heading over the next few months? Are we trying to say that a recession is imminent?
I think it's imminent in the US because already in the first quarter, I think the US is looking at, if I'm not wrong, judging from an indicator called the GDP Now indicator that's released by the Atlanta Federal Reserve, um, is looking at a negative quarterly growth. And so that's the first quarter. And now we're talking about the second quarter. And so you have two negative growth, negative month on month, sorry, quarter on quarter growth, then you have what we call a technical recession. So the US, to me, more or less is headed towards a technical recession. Whether the rest of the world, not too sure yet. Yeah, so I think that's pretty clear. Sorry, what was your question again prior to this? The
The
first
market.
part.
Where do
Oh,
you
the
think
market,
it's
yes,
headed?
yes.
Yeah.
Okay. So that we actually only have two case studies for this. The first case study is, of course, 2018, when Trump basically was his first round of being the president. Where in 2018 he imposed tariffs on Chinese goods and services, or Chinese goods, and that round was, well, I believe there were other countries, but solely China was the main focus. And if you call up any chart, the S&P 500, and you look at 2018, you'll find that the markets basically went sideways to southwards, downwards, because of this particular tariff war with China. And that's only China. And now we are magnifying this many, many times, because it's not China, and you all know now it's 100 over countries. So, and we are now at just the beginning of this whole thing, because April 2nd was the announcement, right? And now we are waiting for retaliation from countries which got hit by US tariffs. We are waiting for the US to then counter retaliate. And then we're waiting for other countries to do other stuff, counter retaliate, and then retaliate, counter retaliate, and then surprises after surprises after surprises. So this is really something which can be drawn out for pretty long, and 2018 showed us that it can be drawn out for one whole year. It wasn't until early 2019, a year later, when I believe that Xi Jinping and Trump came together and had a meeting to roll back some of these tariffs, that the market then started to move higher from there, or at least bottom out. So it takes some time before governments and politicians come to their senses to say that this is hurting not only my citizens, but this is hurting my chance of re-election, and therefore I need to come and sit down and work out a way where I'm seen as not losing, but win-win kind of with the other guy on the other side of the table. I think we're still far away from that. So that's at least probably 3 to 6 months away. Optimistically, 3, baseline 6, worst case scenario 9 months from now. So, if I'm here in the market today, I mean, if you believe the thesis which I've just mentioned, it's going to be like 2018, why should I wait and hold on to my long position if it's going to be in this kind of situation for the next 3, 6, 9 months? Yeah, I'm not going to stay here and wait around. Yeah. And that is the 2018 scenario. If it's the scenario of the 1930s, where at that point in time, that is the second case study for tariffs, where something called the Smoot-Hawley Tariff Act was enacted, where the US raised tariff rates on over, I think, 20,000 goods. If you look at some of these charts that the media has put out and such, where current tariffs have now even exceeded the tariff rates of the 1930s. You will remember that in the 1930s, there was a Great Depression. The tariffs were not the main reason for the Great Depression, but the tariffs were one reason why the Great Depression continued. So what we're saying also now is, if the world goes into a slump, if the US and the rest of the world do not come to an agreement to remove the tariffs, and both sides are stubborn and keep the tariffs on, that slump that the world has gone into will remain for quite some time. Okay, so we are talking about 2018, 12 months Gao Tim. Let's carry on from there. Or we're talking about a 1930, it keeps us in a slowdown because no party wants to give in, and this thing remains for a couple of years. So you take your choice and pick, but the market is saying, I'm not going to wait and find out. I'm just going to cash out, go into treasuries, a bit on gold, keep my cash, wait for things to settle down. Only then, I will go back in when things settle down a bit.
Han? Where do you see the market heading over the next few months? Do you agree with Mr. Sani's viewpoints?
I don't even know where the tariffs are going in the next few hours. I don't know how anyone can make any forecast because honestly, this administration, right? I think you don't have to look too far. You just look 2 months ago, 1st of February, or was it 2nd of February? It launched a trade war on Canada and Mexico, then delayed it for 30 days, and then like he got what he wanted lah. Justin Trudeau and Claudia Sheinbaum, kowtowing to him and say, why are you doing this to us? That we'll give you some concessions, blah blah blah, delay the tariffs, delays them for 30 days. Then in early March, he goes, no, okay, tell you what, I'm gonna still do the tariffs, and I'm gonna add China, and the China is effective immediately, no delays. And then he did more discussions. Then he goes, okay, I won't do the Canada, Mexico ones first. They agreed to do other things, but I'll put them alongside everybody else on April 2nd. So April 2nd comes, he does this thing again, adds Canada and Mexico to the list, along with 190 other countries. Seems that some countries are bending the knee, they call it, or kowtow is the word, right? Or whatever you call it. But who knows, right? Like he's claiming 50 countries have come to him. There are 190 countries on this list. Which 50, the biggest 50, the smallest 50, a mix of which it's all a mess. Even if he says tomorrow, okay, I'm delaying 30 days, 90 days, I think that one thing that's lost already from the market's point of view is confidence and trust in policy consistency with this government, right? So in the past, 2018, 2019, you got a sense that there were some adults in the room with Trump trying to rein him back from saying stupid things and doing stupid things. I think he had a very strong Commerce Secretary, strong Secretary of or Foreign Secretary, just making sure he's within a box, even though the box was a bit bigger than normal, but within some sort of rational box. Now, right, you've got people just saying all kinds of things left, right, and center. Actually, we want the tariffs not for we want the tariffs to there's nothing the EU can do. There's nothing anyone can do. The tariffs are staying on. Some people are saying, oh, we want people to come and give us even better deals. Some people, some of the administration, I mean, Trump himself said, no, Europe needs to not just remove their tariffs, they need to pay back for all the NATO spending. So you're like, it's unclear what is to be done. What is very clear though is that in 15 months time, I want to say, you can expect Congress to push back very hard. Right now, it's right after election, and there's no political pressure. But I can tell you, like this time next year, mid next year, 2026, Congress will push back, if not sooner, because the one thing voters hate more than wokeism and all the mega stuff, the one thing they hate more is not having a job and paying a lot of money for things. So they are gonna punish the Republicans if this continues, like this kind of market uncertainty continues. So that's one thing I know for sure. But from now to then, no idea what's gonna happen in the next 2 hours or so. What's the EU gonna say? No idea. But if this continues, i.e., this uncertainty, yeah, recession. I think JP Morgan, Goldman Sachs is 80% now recession. Odds, I think it's closer to 100 at this stage, 100% recession if this continues.
And the funny thing that you mentioned just now, that we mentioned during the start of the session, is this is totally uncalled for, totally unnecessary, which is why the Wall Street Journal labeled it perfectly, the dumbest trade war in US history or perhaps in history, right? So, keeping you on there, Han, what would you say to those people who are just beginning to invest in the stock market right now? I mean, say, you can dial back the time and then you're currently at this situation where there is a ton of uncertainty and then you have a pile of cash, savings from either your new job or parents' inheritance. What will you probably do with that money?
I would. Ooh, depends. So for me, I try not to look at prices too much. I look at my portfolio positioning. So what I mean by that is, if I decide I want a 50% equity portfolio, 50% fixed income portfolio, at the moment I'm very down on my equity, so I'm probably closer to 60% fixed income at the moment. I would look to rebalance lah, i.e. buy some equities, sell some fixed income, etc. Right? So don't look so much at the prices, look more at your portfolio. Like where's your portfolio right now? But assuming you just literally, I'm starting now, should I go into stocks now? Is the question, right? And I'd say two things. Number one, if you've got nothing in the stock market, put a little lah, right? It's as good a time as any. Put a little of what you think you wanted to put. Two reasons. One, yes, it's now 20% cheaper across the board. You basically wound the clock back on KLCI by 1 year. You're buying at last year price. Not just for a better price, but also for you to get more involved, right? So there's nothing more important than putting a little bit of money at least where you're into the markets to then follow it. Trust me, your heart will follow your money. If you are just looking, you will really not really follow it that closely. So put a little bit. But so that's the first thing I'll say. Yeah, start now. It's a good time to start now with this chaos. But now is not the time to be a hero lah. There's a saying in financial markets which is or investing, which is don't catch a falling knife. The knife is falling now, don't need to catch it. Pick it off the floor, meaning I don't mind missing the first 5-10% of recovery, right? Even 15%, right? Because you don't get points for being early. Uh, you might get really hurt. So classic example, if we are sitting here in kind of mid-March, it's like halfway through the COVID crisis, stock markets are down 15-20% already. In all the way to early April, they went down another 15-20%. In fact, I think they went as low as 40% down across all markets. It would have been a good idea to put some money at the bottom, sure. But it's much better to miss the first 5-10% up move than to catch this falling knife lah. So two things I'll say. If you haven't started anything, start first. Put a little bit. Don't put too much that you cannot sleep. Put enough to keep an eye. Start looking at the markets more seriously. And I'm perfectly happy to not look at the prices too much and just rebalance my portfolio to my target weight. And that will prove out to work in the end, regardless of what you do.
What about dollar cost averaging? Just like putting in a small sum of money every month, regardless of what the price is. Do you think this is still a viable strategy?
For sure. And in fact, what that likely means is that you're going to be dollar cost averaging into equities and risky assets because everything on a risk on basis is down, right? So what that likely means if you're a dollar cost averager is that your entire investment amount this month is likely to be equities lah. So like come to the end of April, you got your normal DCA amount, right? You're likely going to invest all in equities because your portfolio is likely to be terribly unbalanced right now.
Right. Over to you, Mrs. Sani. Just now you mentioned that probably shift over towards treasuries, more safe assets. What sort of approach do you have right now, assuming you are a young graduate or perhaps somebody who just entered the workforce?
So you young graduate, someone just entering the workforce.
Yeah, and they save up a sum of money, and then
Yeah,
they're planning to grow this sum of money for retirement or for a wedding or whatnot.
Then the recommendation is hang on to your money because you don't know what's going to happen. You may lose your job.
Wow.
We have a generation of investors whom have not seen anything like this. I spoke to one or two of my consultants. Have you seen this before? No. Say, I've never experienced. I said, yeah, obviously lah, because you just entered the workforce basically 15 years ago. 15 years ago basically was just right after the '09, so in 2010, for example. So if anybody coming in around 2010, you have not really seen a pullback of this sort, basically. And even if you factor in uh, 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 2008, it's you really have to go through things like the Asian financial crisis, and where we was looking at defaults from major companies, debt level going up. So what I'm trying to say is, it's really the first time for many investors, and it's a harrowing experience for many investors what we're going through today. But it doesn't mean the end of the world. It just means now you need to be smart when you want to invest. 10% is not cheap. I mean, 10% from the high is not cheap because we are talking about a market which has gone up a lot. So if you think that coming down after 10% is cheap, I'm telling you it can get cheaper. And I think people who have gone in over the past 1-2 days know what I'm saying about, what I'm talking about. Okay, so it's a market where you want to, and like Hans correctly says, let the knife drop on the floor, pick it up later. Don't try and catch a falling knife. Let the market stabilize. Don't get kancheong every time the market rebounds and say, this is it, this is the time where the market fly. No. After these kind of sharp rebounds, what typically happens is you will have rounds and rounds of what we call margin calls. This morning, market in Singapore opened 8% down at the opening. That's very characteristics of margin calls because they just simply throw because it's a margin call. I don't care. I'm a broker. You cannot pay. I sell off. And so we're going to have people who are stuck at the top trying to get out, and you are going to and you will have basically this kind of sharp declines. And then all of a sudden you have this kind of rebounds. Why? Because people have gone short the market suddenly, let's say, turn around and buy. And it catches a lot of people because this is the typical dead cat bounce. People jump in only to find out that there's a war of sellers out there who have got stuck at higher levels or looking to go out. So you will have this tussle between the bulls and the bears, and there's a lot of bears out there because this market has been one which has been going up. A lot of people are long. A lot of people, once they lose that the what do you call the bravery of being in this kind of market, after a while they just say no, I'm going to sell. I just don't want to be, my heart is too weak, I can't take it. Yeah. You need to clear these people out before the market really bottoms. And right now we are still at the early stage. So I do believe DCA is the best way. I would probably say although my own thesis is this can last for 6 to 9 months, okay, I would say do a DCA or maybe 18 months. If you have a certain amount of money, DCA it over 18 months. So the amounts may be very small because you're DCAing it over a very long period of time. But it also ensures that if the market does fall, you're not heavily putting a lot of your capital to work because it's small amount. But you're keeping in touch, like what Hans said is very true. You need to keep in touch with the market with these kind of small exposures. And so you will be putting in small amounts over the next couple of months, 5, 6, 7 months. When it comes to a point where you see a few indications, the Fed starts to cut rates. Okay. And that doesn't necessarily mean the market goes up. It just gives more, it underpins the market a bit. The negotiations start to take place. The recessions start to be announced because once it's announced means it's being priced into the market already. So once these indications all come out, that's when you could potentially bring forward all those remaining DCAs that had gone into 2026. You said, I'm pretty confident the market now looks to be consolidating and bottoming. You bring it forward. Then you can put the lump sum in. You may not get the bottom, but a huge chunk would come in at a much nicer level compared to you try and now put in quite a lot at the very beginning. So I think this kind of stretching out the DCAs for the time being, waiting for some kind of assessment that the market is finding a bottom, and then bringing those DCAs back into the present to kind of lump sum them in on bigger lumpy DCAs. I think that would be my strategy.
I guess the bigger question is that is the US still a safe place to invest or not? Considering what we covered for the entire session, so much uncertainties going on, and the current administration proving that they are not really good at handling the wheel. Yeah, they're actually quite stupid, in fact. So should an investor who's already currently invested in the US market change their investing strategy, maybe start to get out of the boat, get out of the train, right, and adjust to a different type of asset entirely? What do you think, Sani?
I think it's a good question. I mean, a lot of people, like I say, have only seen the US go up, and they think that the US is the most investable asset for the rest of their lives. You've not gone through, I'm people like me, I've gone through a certain period of time, like say the 1990s, between 1990 to 1997, prior to the Asian financial crisis. No one wanted to touch the US. It was just all about Asia. It was about the newly industrialized economies, the NIEs. It was ASEAN. It was Korea, Taiwan back then and such. And the US was considered only, losers would go into the US because US was not giving you any returns. Okay? And so therefore, what I'm trying to say is this thing is cyclical in nature, and there are people who come up with charts showing you that true enough, when you put the S&P together with the emerging MSCI emerging markets, you can find a cyclical movement. There are times when the US does well, and the times when US doesn't do well, emerging does well, rest of the world does well, US does well. Then after that, it changes back to rest of the world emerging market. For the past 13 years, we have seen the US outperform emerging market and rest of the world. We are now beginning to see the rest of the world and emerging market outperform. In the past couple of months, if you've looked at any table, you'll find that the US is at the bottom half, and you'll find that the emerging markets, Europe, is at the top half. So there are already signs that people logically look at the US and say it's very expensive. So it's time to move money out. Maybe going forward, there's going to be an additional impetus to move things out, and that's the US dollar. Because one of the key reasons, another tailwind for the US markets has always been the strong dollar. You make 10% on your S&P 500, you have a dollar which has gone up 3-4%. You add them together, you have double gains. But now, one of the theses, and I do believe this is going to be the case, is you're going to have a weakening dollar. So if you're going to have a weakening dollar, that actually makes the US less attractive to invest. So you have a US which is still fairly expensive. You have the US which US dollar is weakening, and relatively speaking, cheaper emerging markets and stronger emerging market currencies. Why not? So I think there is going to be this shift out, albeit certain sectors in the US will still remain strong, like artificial intelligence, where they are the leaders in the world. Yes, but if not, I think the money is going to flow out from the US.
Yeah, Han. If an investor has, put quite a bit of money in U.S. assets for the past year or even the past 2 or 3 years, do you think he or she should adjust or change their strategy in light of the recent tariffs?
Unless personally, I think unless you have some edge that you really understand the US market more than the average person, there's no specific reason to invest specifically in US only equities. But the reason why we all invest in US equities is because they are actually the most internationalized out of all the major indices. What I mean by that is you buy a basket of US equities, quite likely you have a lot of international exposure. So what's in US equities, right? Apple. Where does Apple sell iPhones? Everywhere around the world, not just the US. Google. Where does Google operate? Everywhere, all right, everywhere around the world, not just the US. Visa, Mastercard. Where do they operate? Everywhere around the world, not just the US. So the US stock market actually is not US. It's actually US plus significant amount of global GDP or global economy exposure. I think it's about 40%. Right. So that's the reason why people thought of investing in the US, right? If that no longer remains true in the next 10, 15, 20 years of your investing life, then you may want to reconsider, right? There are alternatives to just going US market, right? What I mean by that is, Sani kind of alluded to two kind of themes you could think about. The first is rather than just going, dump it into S&P, you could dump it into a MSCI World Tracking kind of fund, right, or ETF, right, which is it's going to be significantly US. I think it's still like 60-70% of MSCI World ETF will be in New York Stock Exchange equities, and then the remaining kind of 30-40% will be in like Europe, Japan, London, Europe, Japan, Australia, a little bit of Australia, that kind of stuff. But at least you are not fully into a single country, which I never recommend. Right. If you're thinking of, hey, look, I just need overseas exposure. I don't want. I've got enough local exposure through EPF, through ASB. I need some overseas exposure, right? And you're worried about putting all your money into like a specific stock market or stock market index, that go for that kind of global exposure. You would have still done okay. Why? Because 60% of that global exposure was US anyway, right? So for me, that's the kind of unless you have a specific kind of edge that you really understand US stocks more than others, I would go for that lah. So MSCI World or a combination of MSCI World and MSCI emerging markets kind of index.
Right, right. Yeah, I think we'll transition to the Q&A session right now. We have quite a lot of questions from our patrons. But fortunately, a lot of those questions are repeat questions, i.e., is it a good time to invest in stocks right now? Uh, what are the impacts of tariffs on Malaysian citizens? Right? How should I invest? Should I sell or buy? We answered all of these questions just now, lah. But one particular question is about the crypto market, which you are very familiar with, Han, since you are the founder and CEO of Halogen Capital. So later you can talk more about it. What about the crypto markets in relation to this trade war? Any views? Yeah, take it away, Han.
Okay. Two things. One, what came out yesterday, was that actually let's split up first Bitcoin and the rest of crypto lah, right? So let's talk about Bitcoin first, the largest cryptocurrency. 60% of the crypto market cap is in Bitcoin. But let's talk about Bitcoin first. Throughout this whole chaos, Bitcoin is actually held up pretty okay, similarly to gold, right? It's down maybe 5% on the week. It was pretty much flat the whole week last week throughout the entire uh, uh, um, you know, tariff announcement, tit for tat, even as going into like Sunday afternoon, seemed to be okay. There's a bit of weakness today. Despite that weakness, only 5% down on the week. This is they call it a break in correlation from risky markets, despite it being fairly correlated this year. So interestingly, starting to regain its previous luster as a safe haven asset. And why is it safe haven asset, right? Let me explain to you why. So for those of you who know what Bitcoin is and what Bitcoin does, it's non-governmental, meaning it's totally unaffected by like what governments do to each other in the economic sense, right? It's self-sovereign asset, meaning you can buy it and hold it and put it in your pocket if you want to, or in your computer as it may. So it's starting to be seen in that, like, or rather the characteristics of Bitcoin being a safe haven asset versus just a speculative risk on asset is that dynamic has shifted this past kind of few weeks. Um, that being said, since kind of mid-January, it's gone down by 20% prior to that already. So it's not some safe haven asset, like it's got its own movements. But the key about Bitcoin that has rung through today and the past few weeks is that it is fairly uncorrelated to the rest of your portfolio, right? So it's a high volatility asset, high return asset in many cases, and not very correlated to the rest of the portfolio, which makes it a nice kind of sweetener to anyone's portfolio lah. So to give everyone a sense, Bitcoin down 5% today, I think maybe 4% today, but pretty much flattish from last week's low, right? It actually dropped to 70 something last week already, the previous week. So it's actually flattish from the low of last week. So if you went in at that point, you're pretty much where you were, despite the entire market dropping 20%. Equity is dropping 20% around the world. Right? So just letting you all know that Bitcoin has many characteristics. Risk on is one. Safe haven asset is also one. It really like contradicts each other. But the benefit of being in Bitcoin this week was that a lot of that speculative activity was washed out the previous weeks already. So what was left was the so-called true believers, the guys who say, hey, look, like this asset is tariff proof, right? You can't tariff Bitcoin. Therefore, it stands to reason it should behave similarly to gold, right? And it has behaved more similar to gold than to equities this past week lah.
Right, right. Mr. Sani, same question. The
Mm-hmm.
thoughts about the crypto market in the current situation considering the trade war.
Um, I mean, Han is the best person to talk about the crypto market. Maybe I will just touch on uh, potentially what we sometimes consider as safe havens and give my experience on some of these assets lah. So, for example, gold that we're seeing now holding up very well amid the carnage that we're seeing on equities. Even bonds are holding up pretty well and such. because of the safe haven status. But if this thing prolongs, you will find basically that both gold and potentially even bonds will be hit because I've seen it before whereby initially when the market drops 10, 15, 20%, people are happy that this part of their portfolio is helping to offset some of the losses, if not all the losses on the other side of the portfolio. As equity goes down, gold goes up, bond goes up, and used to be sometimes even crypto goes up, for example. But as this thing prolongs, people lose faith and they become jittery. And they just say, um, cukup lah, aku tak nak main, 不要玩 lah. I don't want to be involved with it because if anything suddenly turns wrong, I'm going to get stuck. So when they still can do so, they are just going to liquidate their whole portfolio. So net, they've not lost a lot thanks to their safe haven performance on their safe havens and the other alternative part of their portfolios. They've done nothing wrong. They've done very well, managed to shield their portfolio, but they're going to sell everything because net when you combine the equity decline and your increase in your bonds and increase in your gold, you're coming out from this whole carnage in a very good position, in a position whereby you then stand one side, you wait for the right time to come back in again because you want to pick up what we call cheap stocks and so on. Yeah, but you can only do that if you're not hurt from this whole thing. And so I also worry there will come a point where what things that are doing well now, both your fixed income and your gold, for example, will start to decline because of this selling, I won't say indiscriminate, but selling of the whole total portfolio to move into cash. If this thing declines, we will reach that point. So I think that's something I think I'm looking out for as this thing continues to see how long before this thing starts to trigger or starts to come into play.
Yeah. Okay, so we have two more questions left from our patrons lah. Otherwise, we will drag the session too long. This one's pretty interesting. I'll pass it to you, Han. Representing those who have purchased houses and are planning to do renovation works over the next few months, in what intensity do these tariffs affect renovation prices? I've heard it would be more expensive. Should we postpone renovating or not? Yeah, what do you think?
Oh, good question. If we have tariffs on building materials from China, then yes, you can expect your renovation cost to go up. But I suspect a lot of the things that people are telling you is just to do two things. One, to go faster, to go now, because things going to get expensive later, right? Better spend now lah. I suspect a smart contractor or smart designer is trying to push you to buy it to give them some money lah. So yeah, but just letting you guys know, tariffs are not. We didn't put up any tariffs on anybody, any new tariffs on anybody. So if you are importing building materials from, don't know, from China or Vietnam or wherever, it's not going to be any different. In fact, it could get cheaper because if the US isn't buying, then the whole market will tank. You can see that happening in oil. You can steel market, steel is down, oil is down, copper is down. Stuff that goes into your building materials actually go down. So I would say life's too short lah. Like if unless you are like betting on your renovation, you just bought a house, you want to renovate. I personally would want to move into my house as early as possible and enjoy the house which I bought. Houses are for living, not for speculating. And certainly not renovation. Don't speculate on your renovation timeline lah. Don't let the markets impact that. Unless you're thinking to conserve cash and not renovate at all, right? Do what Sani said, which is, hey, this could be a 2-year depression. Everyone losing their jobs. Maybe you want to relook at your renovation budget on that basis, rather than because of building materials going up or down.
Yeah, well said, lah, really, because speculation reminds me of like people who are trying to speculate on the currency movements before they go to a trip, you know. And funny enough, you mentioned about this before. As soon as you save up enough money in terms of that currency to go for a trip, then convert it right away, right? Don't wait for market movements. Don't try to speculate these type of things, right? Because at the end of the day, a house is for living, and you're going for a trip for a trip, right? You don't want to be caught at the wrong end of things and then lose a whole lot of money in the worst case scenario lah. Yeah, so the next question and the final one is how can I be better prepared financially for the upcoming chaos? Yeah, Mr. Sani, I'll pass it to you lah.
Don't do house renovation, save money. I'm just kidding. No, no. You
Move
know,
up, move up.
yeah. There's opportunity in chaos. I think anybody, if you, with hindsight, if I tell you, look, what would you have done now in 2008, 2009? Oh God, if I knew, I would have saved a lot of money. I would just sell my car, sell my cat, and put plunk money into the markets in 2008, 2009 when it plunged. What would you have done in 2000 dot-com bubble? Same thing. Asian financial crisis, same thing. And so when we look back, you'll find that basically the best opportunity to make what we call very large returns comes when the market is declining, and that is what people have been saying, right? We all know the mantra, buy when there's blood on the streets. Warren Buffett, of course, when people are greedy, I'm fearful. When people are fearful, I'm greedy. And we always manage to do the exact opposite. When markets are coming down, we are fearful. So who's the person who's greedy? That fella called Warren Buffett. He's going to be greedy. He has a huge cash pile there waiting. So if you think like him, then basically it's time to actually now start to maybe increase your cash holdings by again, I'm not trying to get people to spend less, but if you're thinking about investing and trying to pick up things which will 4 5x when this thing recovers, then it's trying to create that surplus every month, stinge a bit on this. Never mind why, because this is not always happens. So I want this opportunity to get into a share which is now 50% lower than just a couple of months ago, and I know it's a good share. If I buy and I hold, of course it may go down further, but never mind, because I know that the next couple of years this thing is going to 3 4x, because really it's being super oversold now. Yeah. So you can only find these things in this kind of market when the market comes down. When the market goes up, you are buying everything, chasing the market basically. So you won't be able to get this kind of 4 5x stories on going up, but you can get them in this kind of environment. So I would be doing something like that, meaning to say that um, hanging on to or creating as much cash flow as possible, and then picking stuff which I'm more than happy to hold on for the next 4 or 5 years, and sit back and wait lah. Yeah, so basically that would be my strategy lah.
Yeah, Han, how to better prepare yourself financially for the upcoming chaos, or it's already here, this chaos?
Yeah, I think the number one thing is if you're having a job now, prepare for a situation where you might not have a job for 6 months or so. So going back to a financial planning head mindset, 6 months emergency funds, even as big as 9 months, 12 months also is probably not too bad to consider right now, right? And the only reason why you want that is that you don't want to be caught having to sell your portfolio at the wrong time, right? You want to have like a nice healthy runway of, hey, even if I lose my job, I prepared for this. I got 6 12 months of cash to find a new job without feeling desperate. I can wait it out. I can save money, no problem. So that's the first. And second, yeah, I agree with Sani. Like in this carnage, there will be opportunities. Just be patient. You will get them. Even if you're a bit late, never mind. Even if you were 1 whole year late to the recovery after global financial crisis, you will still make a lot of money. 1 whole year late. So don't worry about it. Even if you're 1 whole year late after the COVID recovery, you still made some money. So don't worry, right? No need to rush. So
Yeah,
those two things.
yeah. And does that sort of like sum up the entire session for you tonight, or do you have anything more to add as part of your last word of the session tonight?
I got maybe another last word, which is, you know what I said just now about I have no idea what's happening in the next few hours. Well, 5 minutes ago, what was it? Scott Besson, right? Just said Secretary of Commerce, right? Just said, hey, we might pause these tariffs for 90 days.
Really?
So,
Really?
and then the market's rallied a little bit since.
Wow.
So you're like, okay, great, but like, so yeah, as in, remember what I said earlier about number one is a lot of stupidity. Number two, there's no credibility or no consistency, right? Which will cause concern and actually will cause a recession that way too. Because if you don't know what's going to happen, you're not going to make big investments. So just classic last words there. Yeah, I clearly can't predict anything because clearly, like I told you, next few hours something might change. 90-day pause on all tariffs, right? So you're like, okay, not sure. And by the way, it's not confirmed. This is just the senior advisor, Scott Besson? No, Hassett, not Scott Besson. Trump is considering a 90-day pause. Considering, so on that basis, market suddenly jumped back up and now back down again. So long story short, like don't play this market lah. Like don't catch this knife lah. It's not worth it. Get in only to if you are totally uninvested, put in a little bit to stay interested. That's all I'll say.
Yeah, Mr. Sani, last words over to you of tonight's session.
Don't leverage. Yeah, because these are markets where you leverage because maybe you've got market swings are 10%, you want to leverage. When market swings are 20, 30%, 40%, you can get hurt. So I think you need to be very careful. Don't be tempted to borrow and invest. Don't be tempted to leverage and invest. It's not it's because I think a lot of people are still um, I wouldn't say the word to use is they are still predominantly bullish because of what has happened over the past 10 years or 15 years on the S&P. So when they see a decline of 20, 30%, to them it's the best opportunity, and I'll pile up the leverage and so on and so on and so on, because it's not going to, I've never seen this thing before. This is cheap and cheap and cheap. You just have to be very careful. Just always be mindful of your exposure and don't get yourself overexposed, which you can quite easily with leverage.
I guess it boils back down to the financial planning, basics, which Han mentioned just now, right? Make sure that you've built sufficient amount of emergency funds, 6 to 9 months. Best case scenario is 12 months, right? Where you'll be able to sustain yourself for the next 12 months, be paid consecutively for 6 to 12 months, even though you don't have a job, because there is a real risk of mass layoffs coming if there is a huge recession. But yes, that sums up our entire session tonight. It's almost 1.5 hours. Hopefully, you guys enjoyed it. And also, these two speakers are our advisors. They are in a WhatsApp group with us. Yeah, with over, I think, 300 plus members right now. So if you do want to join our WhatsApp group, you can click on the link tree in our bio as well. So final words is these two speakers, obviously, they have shared a lot of insight for the past 1.5 hours. Do them a favor, click on both of their profiles. Only takes 2 to 3 seconds. Just tap on follow lah. I think they deserve the follow considering how much knowledge they've shared. All right, I'll see you guys in the next one. Thank you so much. Bye. And remember, don't catch a falling knife. Right,
Thank you.
good night.
Right.